The law of large numbers is the statistical cornerstone of the national portion of the life insurance exam because it explains the transition from individual uncertainty to group predictability. You will encounter questions that ask how an insurance company can remain financially stable while taking on the risks of thousands of people. The answer lies in the principle that as the number of similar exposure units increases, the actual losses observed will more closely align with the expected losses, calculated by actuaries. Think of this like a casino or a coin toss. While it is impossible to predict the outcome of a single flip of a coin, flipping that coin 10,000 times will almost certainly result in a 50-50 split. In the world of life insurance, the coin flip is the mortality of an individual. An insurance company cannot know if a specific 40-year-old non-smoker will die this year, but they can know with high precision how many out of a group of 100,000 40-year-old non-smokers will die. This predictability is what allows the insurer to set a premium that is both competitive and sufficient to pay out all future claims. When you are sitting for the exam, you must be alert for the word homogeneous. The law of large numbers is only effective when the group being studied is composed of similar risks. If an insurer tries to group disparate risks together, such as professional athletes and individuals with chronic illnesses, the statistical data becomes unreliable. This is why underwriting is so critical. Underwriters ensure that the people being placed into a specific premium pool truly belong there, so the law of large numbers can function properly. A common exam trap is a question asking if this principle allows an insurer to avoid loss entirely. It does not. Instead, it allows the insurer to predict loss so they can prepare for it financially. It moves the risk from the realm of the unknown into the realm of the manageable. Another area where students get tripped up is the distinction between the law of large numbers and the concept of mortality tables. While they are related, they are not the same. Mortality tables are the actual charts showing death rates, whereas the law of large numbers is the mathematical principle that gives those tables their validity. You might see a question asking what happens to the margin of error as the number of insured lives increases. The correct answer is that the margin of error decreases. The more data points the insurer has, the more their actual experience will match their predictions. To help you remember this on test day, use the phrase, large groups lead to logical losses. This reminds you that the size of the group is the catalyst for making loss logical and predictable rather than random. Remember that insurance is the business of spreading risk across a large pool of people. Without the law of large numbers, there would be no way to calculate a fair premium, and the entire system of risk transfer would collapse. It is the tool that turns the gamble of life into the calculated science of insurance. Focus on the idea that this principle predicts the frequency of the event for the whole group, never for the individual person. If a question asks about predicting individual outcomes, that is a red flag to look for a different answer choice, because the law of large numbers only deals with the collective. By relying on massive amounts of data, the insurer can absorb the shock of an individual death because it was already accounted for in the mathematical model of the group as a whole.